Thank you for joining us for this webinar update with Amy Pham, the Portfolio Manager for the Pengana High Conviction Property Securities Fund. The fund is Australia's only high conviction A-REIT fund with an ESG focus. Amy today will give you an update on the fund and how the portfolio is currently positioned. The presentation will run for approximately 30 minutes and Amy will answer any questions you may have following the presentation. You can enter your questions in the question box at any point throughout the presentation by selecting the icon at the bottom of your screen. Amy, over to you.
Thank you, Paula. Good morning. Thank you for joining us today. What I wanted to do is provide you with an update of the fund, what's happening in the market, and how we're positioned. Since my last update, we've added a new team member, Sam Craig. We have a stable team with Jade and I have been together since inception of the fund. Between the three of us, we have over 45 years experience with diverse and complementary skill sets. I have over 20 years experience in funds management. Jade came from a real estate corporate background and Sam has direct property research background. We continue to grow the fund and are available in more platforms. Currently, we're on Macquarie Wrap, NetWealth, Mason Stevens, and New Exchange. We're also pleased to get an investment grade rating from Lonsec and maintain a favourable rating from SQM. The fund's main objective is to provide capital security, income yield, and sustainable growth. And this is achieved by adopting a high conviction strategy with a focus on ESG and secular trend. Being high conviction means that we're benchmark and aware. We take meaningful positions with a concentrated portfolio with a maximum holding of 20 stocks, and through our stock analysis, pick the best of breed. Our approach to ESG is qualitative and is used to manage risk. We conduct our own research by a questionnaire which feeds directly into our valuation model. REITs in general have strong ESG credentials and is becoming a requirement for many investors and tenants alike. For example, Mirvac have highlighted with the EY Centre in Sydney, where they have increased the neighbours rating from 5 to 5.5 stars, have contributed $4 million to valuation uplift and cost savings of over $200,000 for their tenants a year. The team also focuses on identifying new growth sectors driven by secular trends. We believe this provides further diversification and sustainable earnings growth. We don't just stop at E, we also take considerations of the S. For example, we invest in social infrastructure REITs such as childcare and retirement living, which will further support government and also addresses the underlying social needs. Turning to slide 7. This table highlights what you would get by investing in REITs. You get a reliable income yield of about 4 to 5%, which compares favourably to term deposits. It provides capital protection and is backed by a tangible asset. The sector is currently trading at a 6% discount to NTA if you exclude the fund managers such as Goodman, CNI, and Charter Hall. It provides you with protection against inflation as rents are indexed to CPI. It also provides liquidity with daily unit pricing and good ESG ratings compared to its global peers. Over to the next slide. There's a few positives and challenges in this sector at the moment. With the Ukraine war and new lockdowns in China, we see further pressure on supply chain disruptions and inflation. Speaking to many REIT managers, Australia is seen as a good safe haven for offshore capital, with a lot of investors keeping their powder dry and ready to deploy once things are fully opened. Property is seen as a good inflation hedge. Why? This is because rents are typically indexed to CPI. Construction costs have increased by about 10 to 15%, but are usually within feasibility ranges, and developers have been able to pass on costs to consumers. However, this is something that we continue to monitor. With rising interest rates, it affects earnings through higher debt costs, particularly for REITs that has high gearing and a large proportion of their debt unhedged. It also flows through to higher discount rates, which places downward pressure on valuations. Based on the last reporting season, property valuations has been stable or continuing to improve from its COVID lows, particularly for retail stocks, with sales growth recorded over 10% of pre-COVID levels and an improvement in releasing spreads. For office, we're seeing stabilization of incentive levels of 30% and a preference for high quality products with good sustainability ratings. And then for industrial, we are seeing strong rental growth starting to come through, particularly for infill locations. Also, what we've noticed in the last reporting season is that many REITs are diversifying their income streams by accelerating their move into funds management, involving more in developing their own products and also into alternative sectors. Moving on to slide 9. Now, this is a really interesting chart for us. What it shows you is where interest rates are and what the market is implying. From the current cash rate of 0.35, the market is actually anticipating that the RBA will raise rates to 2.8% by the end of the year, represented by the final dotted line at the top there. Now, this is much higher to where consensus is, which is at 2% represented in the yellow dot, and also much higher than the equilibrium position at 2.5. What this tells you is that the market is predicting that we'll follow the lead of the US with very aggressive rate hikes to contain inflation. But really, our economy is not as hot, where our inflation rate is only at 5.2% compared to the US at 8.5%. So we do anticipate there will be rate rises from these very low levels, but not as aggressive as in the US. Moving to slide 10. We believe the sector remains attractive for the following reasons. It is a defensive sector, as property is less exposed to broader corporate earnings with income supported by long-term leases and has a net tangible asset backing. Looking at the capital position, most REITs have a conservative gearing of about 30%. However, we take this one step further in our analysis. We look at the interest cover ratio, which assesses the ability to service debt on a free cash flow basis. And as a general rule of thumb, we would not invest in a REIT that has an ICR of less than 3 times earnings. REITs also provide a good hedge to inflation, as rents are typically structured at about 3 to 5% fixed increases or linked to CPI. For example, Arena REITs has 75% of its rent review either linked to CPI or higher fixed increases. As a result, on a risk-adjusted basis, REITs provide an attractive total return of about 10%, which is made up of 4% dividend yield and 6% EPS growth. The sector is also evolving with opportunities in new growth sectors. We like the alternative sector, which are driven by secular trends and are less cyclical than your traditional real estate sectors such as office, retail, and industrial. In Australia, alternative sector only makes up 6% of the index compared to more mature markets such as in the US and the UK, where it makes up more than 50% of their benchmark. We think that there's a real opportunity for REITs to grow through alternative assets as the sector becomes more institutionalized. Looking at our performance, this chart shows our performance since inception. If you invested $100,000 when we launched, which is 2 years ago, you would have grown your investment to $133,000 compared to the index of $113,000. Looking at how we're positioned over the past 6 months, it is a concentrated portfolio of 15 stocks relative to the index of 30. However, the fact that we're benchmark and aware means that the composition of our holding is much more diverse relative to the benchmark. Looking at our top 5 holdings, there's only 2 stocks that we hold from the index. That is Goodman and GPT. We also have 22% exposure to alternative sector compared to the index of only 6. As you can see from the chart from the left, At a subsector level, we remain overweight best of breed in a diversified sector, underweight discretionary retail such as Centre Group and Vicinity, and prefer convenience retailing with its defensive nature. We also underweight office with preference for high quality assets such as Mirvac. And lastly, we retain a strong exposure to alternative sector such as childcare, retirement living, healthcare, and data centers. So over the next slide, what I wanted to do is really focus on what's worked for us and what hasn't. The things that work for us is our exposure to convenience retailing, particularly SCA Property Group. What really drove the performance of these stocks is that it is defensive retailing with favourable lease structures, typically CPI linked, with a large component to turnover rents to capture inflation. We're also seeing an increased use of space by the supermarket tenants to fulfill online sales, which landlords are able to capture as part of their turnover rents. In terms of our childcare exposure, it has benefited from an increase in government spending, particularly heading into election, with Labor promising over $22 billion per annum spend should they win the election, which is double what the Liberal policy is at the moment. The fundamentals are strong for childcare, with limited supply coupled with low operating costs to sustain rental growth going forward. Our position in Irongate also added to performance. We held the position as we saw it was a defensive play during COVID, with long WALE and also exposure to government tenants. Recently, it was subject to M&A activity, which saw an offer of 12% premium to NTA. With our infill locations, the move from just in time to just in case, along with supply shortages for infill locations, continues to drive rental growth for these assets. Moving on to the next slide. The things that didn't go our way is our exposure to fund managers and resi developers. Fund managers has been under pressure since the beginning of the year. The market views the rise in interest rate will increase the cost of capital, making acquisitions harder. Also, as 10-year bonds are used as a proxy for risk, higher bond rates translate to high risk and lower valuation. Despite the market favouring value stocks in the short term, we believe the fundamentals for these stocks remain strong and will be driven by substantial development pipelines, deep global institutional capital relationships, and an increased allocation to unlisted real estate. For resi, talking to developers, cost inflation has increased by about 10 to 20%. Our key focus for investing in the developers is their ability to maintain market share and are in a strong position to pass on the cost increases. For example, we recently increased our weighting to lifestyle communities after attending a property tour, which validated our belief in their ability to pass on costs and maintain the development pipeline, primarily due to their strong relationship with their sole builder, Todd Devine Homes. We're also seeing delays in settlement due to rain and COVID-related labour shortages, with settlements now pushed into the next year, but settlement guidelines are maintained for FY23. Turning to slide 15, which lists our top 5 holdings. Now, I won't go through each of them, but what I'll do is that I'll keep it open at the end of the presentation. So if anybody has questions, we can go through each of them. Turning to slide 15, this highlights our investment process. There's no change to our process. The key areas that we're different, that we do differently is that we focus on secular trends and incorporating ESG into our process. The next slide shows you how we incorporate ESG into our process. We screen out due to poor corporate governance, and this leads us to a universe of about 50 securities which we can invest in. We, as I said earlier, we conduct our own in-house ESG research via questionnaire, which provides us with more insight into the ESG factors, and also we can discuss the issues with the managers themselves. ESG factors make up 30% of our valuation, so it does have a big impact on our rankings. It is qualitative, similar to how we rank management. So looking at slide 18, where we've highlighted some of the key observations in the past few years. So ESG is becoming more important in REITs reporting, with each presentations devoting about 1 or 2 slides to ESG factors. A lot of the larger REITs have made significant progress in achieving their Scope 1 and 2 targets, with the focus now on Scope 3, which account for more than 90% of the emissions. For example, Mirvac achieved net positive carbon emissions 9 years earlier than their target by maximising energy efficiency and adopting 100% electricity usage. This slide here on slide 19 highlights the alternative assets that the portfolio is exposed to. And because of that, we're able to provide a much more diversified exposure compared to the index. With that, I'm going to hand over to Paula for question and answer.
Thank you, Amy. We have a couple of questions that have already come in. If you have any questions, please enter them in the box now. We've got a little bit of time. The first question is quite topical. There's actually 2 related questions. How do you see the upcoming election impact the REIT sector? And related, what are your thoughts on the PM's policy announced this week around first home buyers?
Yeah, I think, with rising inflation and rising interest rates, addressing, affordability is key for the election this year. Now, what the PM has announced in terms of policy this week is that there's 2 announcements. The first one is that there'll be that young people, first home buyers, can access their superannuation up to 40% of the superannuation, and which is capped at $50,000 to buy a home. Now, I think that is a good thing, but the problem with that is that it could temporarily push up prices further. However, you can say that it cushions the impact of the rising interest rates as well. And then the second announcement that the PM made this week is that that retirees can contribute earlier to the superannuation from the age of 65 down to 55. Now, what impact that has on particularly our portfolio is that we see that as a benefit, because that would encourage more retirees to downsize, and that would be beneficial for our holdings such as Lifestyle Communities and Ingenia.
Great, thank you, Amy. One question, what keeps you up at night?
Well, the market's very focused on macro views, which is, rising interest rates and inflation. At the moment, I think that the risk for us is that, if we have this persistent inflation, rising wage, with, a lift in the minimum wages, and also a very aggressive mood by the Feds, that would further validate the RBA to follow what the Fed's doing. So, for us, we're watching this very closely. But then on the flip side is that if the RBA adopts a very aggressive, hike in rates, this could really, really slow down the economy, because, as you know, in Australia, our economy is very, very much tied to the housing market. And at the moment, a lot of people, as you know, are very stretched in terms of affordability. So we're keeping a close eye on it.
Okay, thank you, Amy. Okay, the next question. The sector has benefited from cap rate compressions. Where do you see valuations going forward?
Well, certainly in the past 10 years, the market has benefited from cap rate compressions, and with the rising rates where it is now, I think that's pretty much behind us. I think going forward, we see that for retail and office, we see a stabilization in valuation. But I think that for industrials, there's further cap rate compressions for industrial assets, mainly driven by strong rental growth, similar to what the global peers is experiencing at the moment, with rental growth of about 10 to 15%.
Okay, thanks, Amy. Next question. In your ESG process, if there's a stock that's exposed to an unethical sector, have you ever had a case of that happening?
Look, because we're not an impact fund, we are an ESG fund, which means that 70% of our valuation is driven by financial factors, and then the other 30 is through ESG. Now, ESG does have a very significant weighting in our valuation of 30%, but really looking at our holdings in the past, there's no unethical stocks that's been included into the portfolio.
Great. One final question. Why are fund managers particularly impacted by rate increases? And how leveraged is your portfolio, and how does that compare to the benchmark?
Yeah, so fund managers, there's two things driving the underperformance of fund managers with a rate rise. The first is that it increases their cost of capital, right? So it means that their ability to grow via acquisitions of assets is a lot lower now, right? So that's the first thing. The second thing is that usually 10-year bonds is used as a proxy for risk, right? So the higher the 10-year bonds, the higher risk, which means the valuation of long-dated assets, which is real estate, will fall. So there's two things affecting it.
Great, thank you, Amy. It looks like there's no more questions. We might finish the webinar here. Thank you, Amy, and thank you all for joining us for this morning's update. If you do have any other questions, please do not hesitate to get in touch. We'd love to hear from you. The next webinar in the series is this coming Thursday, the 19th of May at 9 a.m. Sydney time, and it's with Harding Loevner, the investment team for the Pengana Harding Loevner International Fund, and for our listed investment company, Pengana International Equities Limited, or PIA. Registration details can be found on our website. Thank you again all for joining us, and have a great day.